Welcome back. This is part 3 in our series on federal student loans. In part 1, we covered the details of income-centric plans like pay-as-you-earn and revised pay-as-you-earn. In part 2, we covered discretionary income and how it's used under these plans to figure out what your payment will be. And today we're going to go a little broader. In part 3, we're going to talk about deferment, forbearance, and what happens to your federal student loans when they are forgiven under these plans. Let's get started. Many people hear the terms deferment and forbearance and they really don't understand the difference in terminology. And while it is true that with both of these, you're not paying your loans or your principal or interest back for a period of time, the ways that they could affect your loans are very different depending on the type of strategy you're using and the type of loans that you have. What are some of those differences? Deferment means that for a period of time, you're not paying the loan principal or the interest back on your loans. And you could be in deferment for a number of reasons. You could be in school. You could be active duty military. You could be someone who's had a real financial hardship or can't find a job. All of these are reasons why you could be in deferment. And the way that will affect your loan and whether you need to handle it one way versus another could be greatly impacted by the type of loans that you have. And to explain that, we need to introduce a couple terms. We need to introduce unsubsidized loans and subsidized loans. See, subsidized loans are typically loans that are taken out for undergraduate studies. And the difference between a subsidized loan and an unsubsidized loan is with subsidized loans, while interest accumulates on your loans, in periods of deferment, the government pays for the interest for you. So for example, you are in school and you're taking out a loan, say $20,000. As the interest accumulates on that $20,000, by the time you start repaying it, you won't have to pay the $20,000 plus the interest. You will only have to pay the $20,000. That is a subsidized loan. Unsubsidized loans work differently. Unlike their counterpart, with an unsubsidized loan, which you typically find in graduate studies, any interest that's accumulating during that time of deferment, you are responsible for. The government is not paying it for you. So if you're comparing the two, let's say that you're in a period where you owe $20,000 and you have an unsubsidized loan. During a period of deferment, you have the option of paying neither the principal or the interest, or you could decide to pay at the very least the interest that's accumulated. Why would you want to do that? Well, I'll tell you, and we have to introduce another term, capitalization of loan interest. Let's go back to the person who owed $20,000. If they owe $20,000 in an unsubsidized loan, let's say they're in a period of deferment. And by the time they're ready to start paying, they find out that $5,000 of interest has accumulated on that loan. If they have chosen not to pay back the interest during their deferment and they choose not to pay it back before their loan payments start, then that interest will capitalize, meaning it will be added on to their principal. So now, instead of paying back $20,000, they will be paying back $25,000. Now, if you're saying if they're paying the interest, what's the difference between paying the interest and the principal? It's all about their loan payment. You see, if you have a standard repayment plan, whatever you're paying is based off of what it will actually take to pay your loan balance off in full in a given period of time. So if you started and took out $20,000 in loans and have a 10-year standard repayment plan, that payment that you're offered is going to be what's needed to pay off the $20,000 with interest in a 10-year period of time. But if you have $5,000 of interest that's accumulated and you let it capitalize, well, now they're basing your 10 years worth of payments off of not $20,000, but $25,000. And because of that, it could take far more to pay off that loan, which means you have a higher monthly payment. So if you're in deferment with an unsubsidized loan and you have the option of paying the interest on that loan, it is worth considering, because if you don't, you could risk having a higher payment when you come out of deferment and restart your payments in full. Forbearance is similar to deferment in that you have a period of time where you're not paying the principal or interest. You're not required to. But unlike deferment, many of the things that would lead someone to being in forbearance are centered on things such as financial hardships. You find people who are in medical residencies who don't make enough to pay their loans who are offered forbearance, or people who are active military duty. And there are two different types of forbearances. There are discretionary forbearances and there are mandatory forbearances. Discretionary discretionary forbearance means it is at the discretion of your loan servicer, meaning you submit a written request, you tell them your situation, and that loan servicer determines whether or not they're going to offer forbearance to you. Mandatory forbearance works differently. With mandatory forbearance, it means you are in a certain program or meet certain criteria. That means your loan servicer is required to at least offer you forbearance. Some of the things I mentioned earlier, like a medical internship, a dental residency, active military duty, those are examples of things for people who would require or be offered a mandatory forbearance by their loan servicer. And it's up to you whether you choose to take it or not. Now, the difference in terms of how it affects your loans compared to deferment is unlike with a subsidized versus unsubsidized loans in deferment. It doesn't matter what type of loans you have when you're doing forbearance. Interest will accumulate on that loan and it will not be paid by the federal government. So we mentioned in deferment where you have a subsidized loan, you could have it in deferment and not worry about the interest capitalizing before you start your payments. If you're in forbearance, it doesn't matter what type of loan you have. By the time you start paying, those loans will have capitalized if you didn't pay interest during your time of forbearance. So again, if this is something that you find yourself in, you want to make the decision of whether it's worth, even during that period of time, paying the interest that's accumulating on that loan to make sure that you don't have a higher loan payment when you start back up. Now let's talk about loan forgiveness. When I started this series, I was going to include the public service loan forgiveness in this video. And I'll tell you that could be an article in and of itself or a video in and of itself. So what we're going to do is we're going to write a blog post about it and we'll link to that article. And today we're going to talk about loan forgiveness in the context of the 3 income-based plans that we talked about in the first video. The income-based repayment plan, the pay-as-you-earn, and the revised pay-as-you-earn. See, if you remember that video, we talked about the stipulations, the requirements of that program, and at their core, they all ask you to pay a percentage of your discretionary income. Remember, it's based on how much you make instead of how much you owe. And when you do that, there's a possibility that all of your loans would not be paid off by the end of the repayment period. So those loans give you the opportunity of having those balances wiped away after either 20 or 25 years, depending on the type of plan that you have. But it's important that we talk about how those loans are forgiven. If you get to the end of the repayment period and you have an amount of loan that is wiped away or forgiven, the following year, you'll have to pay income taxes on whatever has been forgiven by your loan servicer or by the federal government. Let's look at an example. Let's say we have a person who makes $75,000 a year and they have been paying on a income-based repayment plan for 25 years. So they have completely filled their requirement of 25 years of qualifying payments under this program. That means that anything that's left this year will be wiped away. So let's say at the end there are $25,000 worth of loans that they still have that the federal government is going to forgive at the end of this period. The next year, when they file their income taxes come April, they will not only pay income taxes on their $75,000 salary, but also the $25,000 worth of loans that are forgiven. Now, I hear a lot of people that complain about this, but I would say if I were this person, I would much rather pay the taxes on $25,000 than actually have to pay back that $25,000. That's all I've got for you today. I hope you enjoyed this video. I will make sure that we link to the article on the public service loan forgiveness, but I do want to remind you that if you have information that you want to read further on or just things that we didn't cover, then you can find it on www.studentaid.gov. Everything is available for you there. If you liked what you heard, I invite you to share it with as many people as you possibly can because we want to help as many people as we possibly can. And if you have a question you want submitted for a future video, you can do that by going to my website, www.brentonharrison.com, and under the blog section, there is a questionnaire you can fill out for future topics. Hopefully you'll join us in part 4. If you are here in part 4, we're going to cover student loans for married couples. We'll cover how it affects your payment and even what happens to your student loans when you die, or if maybe unfortunately you divorce your spouse and you have student loans. See you next time.